You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupe as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today I'm going to talk about the top lessons that we've learned from 50 plus deals that we've been involved in over the last few years. So lesson number one is that diversification is very, very helpful. Look back towards 2019, 2020, we were, at least for multifamily, very much an up market. Rents were going crazy. Cap rates were compressing. A lot of people were making a lot of money on a lot of deals. Groups had 10-year plus track records in some cases of delivering 25 plus internal rates of return. And it would have been easy for some to just pile all their money into, the groups that were, generating 25% returns, just buying, renovating, selling, using short-term debt just because they were in and out of these things in less than 2 years in many cases. And, very easy to be like putting all your money into one basket of, say multifamily Sunbelt. And that would have proven to be pretty big mistake. When we started investing in 2020, we did focus relatively heavy on multifamily, but we also had a combination of other assets, including self-storage, including ground-up senior living, senior student housing, some performing and non-performing mortgages. So that diversification has proven very helpful. And even though we certainly have a few assets that have some challenges, overall, we've avoided that, anything catastrophic at this point. Although, any one individual deal could go sideways. So in addition to those asset classes, we've also identified a very much of a niche asset class in marinas. We really like the marina space, high entry cap rates, various cash flow streams, and reminds me a lot of what self-storage and mobile home parks were perhaps 10, 15 years ago. And I do think it'll get somewhat more institutionalized over time. Second lesson that we've learned when we look at some of our worst performing deals is to avoid deals that have many, many small partners involved and where the main operating partner is not really high net worth or super liquid themselves. The only deal that we've lost entire investment on out of this 50 plus was actually at the time a sponsor that had a great track record, but unfortunately bought a value add asset in Dallas at probably the very worst time, overpaid a little bit and look, from our perspective at that time, generally the going in cap rates were all very low, but raise rents, renovate, they had a great track record of renovating. And, the market was hot. So, unfortunately we did participate with a small amount of capital. It was 3% of our fund. So not anything catastrophic, but what sunk the deal more than anything was that the investor base was a lot of small investors. And when they needed to make a capital call, which would have been about 30% additional capital, they failed to do so. So instead of being able to, pay interest for another 2 years until interest rates subsided, and perhaps finish the renovation plan, the deal unfortunately ended up going back to the lender. Now we're in, a few other deals that have variable rate debt, but when you have sponsors that fit into two categories, one type, they have their own balance sheet. They're heavily invested themselves and they can write a 7-figure check themselves to, replenish the interest reserves or even in the case of refinancing into fixed rate debt at a lower loan to value, they have the financial wherewithal to do that. So Those deals have been much safer. The other scenario is where there's at least one or two very large LPs in the deal that have a lot of skin in the game and that are professional investors. So a few of our deals are with a high-profile syndicator. I'm just not going to use individual names on the podcast for various confidentiality reasons, but they're a known syndicator in a lot of the trade magazines, and they have had some high-profile press. There are properties that have been foreclosed that they were the lead on. However, the deals that we're involved in have one or two large anchor investors. So we've made a number of capital calls, and because there's a large anchor investor with multi-millions of dollars in the deal, when those capital calls happen, those investors have other liquidity, and those investors know it's in the best interest of the partnership to make that capital call and to preserve the health of the investment so that we can get towards a much better solution. Over the course of the next 2 or 3 years, as it appears rates should at least come down to some extent. And in these key markets in the Sun Belt, there's also there's a lot of new supply that hit the market this year. However, permits have plummeted since 2022. So really, there's not much. Once this new supply is absorbed now, when you fast forward 2 or 3 years, there shouldn't be really anything else coming to market. So it really just gives us the chance to complete the business plan over a 5-year period, whereas we might have thought we were out in 2 to 3. These loans are extended to 5, and it gives us the best chance to make a successful exit of the property. So these balloon payments or these extension fees, if you're on variable rate debt where you need to extend the interest rate cap, that's probably the biggest risk to these syndicated deals. And it's the biggest difference if you're coming from single family, where you're investing in a bunch of 1 to 4 family houses, where you can get 30-year fixed and you can lock in, even if rates are higher now than 2 years ago. But even if you're taking a 7% interest rate now on a single family, you are generally locked for 30 years. Even if you're using some of the non-bank lenders, or a community bank, usually you're getting 5-10 years before any balloon payments. So this is the biggest risk, and it's very important that you're with a GP or an operating partner that has the wherewithal to manage these risks when it comes to the loans coming due. I kind of mentioned it a bit earlier, but I want to do a little bit of a deeper dive into being aware of aggressive economic assumptions, especially in the high growth markets where there's a ton of new supply. And I've had mixed feelings about this, and I'm going to give both sides of the point here. Take a market like Dallas, for example. There's a ton of new multifamily that was built over the last few years, and it's really coming to market this year. Now, new supply is generally higher end, and that may mean the rents are in the $2,200, $2,300, $2,500 range. A lot of the apartments that we're invested in, is what I'd call Class B workforce housing. And generally the rents, may be as low as $1,100, $1,200. And after a renovation, they may be going on average to $1,500, maybe $1,600, 2 bedrooms, maybe a little bit higher. So you could certainly make a case, and we've made that case, and a number of our partners have made that case that it's really 2 different markets, and new supply coming in at $2,300 to $2,500 is not going to impact it. What we've seen is perhaps a mild to, in some cases, moderate impact, and I guess that's really what you would consider a trickle down. When new supply comes in at $2,500, the previous Class A that was renting for $2,100, that's maybe 5-8 years old, starts offering. Rarely do they just cut rents, but what they'll typically do is offer some incentive, perhaps 1 month free. And so what is happening to some extent is that those older Class A's are potentially poaching some of our higher end tenants that might have previously rented for $1,500, $1,600. But if they can get a $2,000 apartment with 1 month free, that works out to perhaps $1,800. And there is a base of the tenant base that seems to be moving up. So we've seen pushing rents has not happened as much organically. It doesn't mean when we take a $1,200 apartment and put in new kitchens, new bathrooms, that doesn't go to $1,500. That value add strategy, which I've harped on in many podcasts, that we really focus on what can we control. And what we can control is renovating a unit that used to rent for $1,200 and ensuring that we know what it's going to get afterwards. So those rent increases have been obtained nearly across the board. But what we've been seeing is vacancy rates have ticked up a percentage or two, and the organic rent growth, which during 2021 was crazy. We were renewing. There were some scenarios where you just didn't bother renovating because you'd get a 10 to 15% rent increase just by a renewal. And, you just renew when you could, and, there'd still be organic, people moving out for various reasons. So certain apartments would still be vacant and you'd have enough vacant units to renovate, but, it made more sense just to renew various tenants and take that rent increase without spending any money on renovations. And the other, issue is that savings, and I've seen recent charts from the Fed where, any savings that had been built up from, the COVID, subsidies, various money, and or just the cost savings from people just not going out, not being able to travel for a year has generally dwindled at this point. So I think inflation has eaten up a lot of that savings, that and just spending, going on vacations, doing all that pent up demand from COVID. So, it does seem that the economy has been softening a little bit. Very hopeful that these rate cuts happen in September. And, it does seem that the economy's, soften a bit, and that although inflation's not quite at that 2%, it seems like the Fed is aware that there are some lagging indicators, and perhaps in 3 to 6 months, we'll see ourselves closer to that. And, at that point, hopefully the rate cuts happen over the next year and lowers the borrowing costs for us as investors. And, more importantly, the lowering of the borrowing costs, although the cap rates are not, it's not in the calculation specifically of the cap rate, because the interest rate is not involved. The interest cost is not involved because it's the great equalizer. Ultimately, with a lower borrowing cost, the cap rates will typically compress, meaning that when interest rates go down, typically the value of apartment buildings does go up. So that bodes well for us if that happens. And the hopeful scenario here is that in, say, 2 years from now, there's not a lot of new supply, because when interest rates went up, the cost of construction went up, along with all the supply chain issues and the cost of materials due to inflation. So not as much has been built, and permits are generally at historical lows. Since the Great Recession, there was really not a lot of new supply for about 10 years. There was a drastic undersupply that did tick up over the last couple of years, but once 2022 hit, the new permits really dropped dramatically. So an ideal scenario is rates are low in 2 years. We avoid a major recession and have somewhat of a soft landing. But when we go through and are selling, or a lot of the investments we're in are liquidating, that we're in a relatively low supply market, and with rates at least stabilized. They don't need to drop anywhere near where they were in 2020 and 2021. We don't need anything drastic like that. Just really some stability more than anything else, because what you've had is with these rates up, there's been a lot of frozen capital as well. Even people in good deals, there's no incentive to sell early if you had a 3% rate. So there's actually a lot of equity trapped in deals that just aren't liquidating one way or the other. So could be another benefit as rates stabilize and drop a bit. It's going to unlock a bunch of capital, because there's deals that are just sitting there where investors' equity is locked up. And so once those liquidate, especially if it's at a profit, those investors need to redeploy their capital, in most cases, either through a 1031 to buy something else, or to just reinvest and get some depreciation to offset the gains and the profits from the successfully liquidated asset. So couple lessons. Hopefully this was helpful. Please remember to like and subscribe. Our YouTube channel at JKAM Investments, our podcast on Spotify, iTunes, or your platform of choice, and engage with us on social media. We also have a Facebook group called the Alternative Investor Mastermind. We do put some exclusive content up there. We're going to do some more live streams, and I look forward to seeing you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at AlternativeInvestorMastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.